welcome to HardAssetsInvestor.com. I'm Mike Norman, your host, here with my guest today, Matt McCall, who is the president of Penn Financial Group, returning to the show. Matt, it's been a long time. Welcome back.
Thanks, Mike.
I wanted to have you here to pick your brain on your outlook on the commodities markets. I know it's an area that you are very, very active in. And I know that the last time we spoke, you were a major roaring bull in commodities. That's played out. But recently, we saw somewhat of a correction, in many areas, particularly, why don't we start off with oil, where we saw the market peak out in April around 114. We got down to about, I think, 89 something, seeing a bounce back now. What do you see for oil for the rest of the year?
Well, I think there's two drivers when you look at oil. One's going to be obviously the global economy. If people perceive the global economy bouncing back up, I think you're going to see oil triple digits very easily.
Do you see that bouncing back up?
I do. I think the summer months are going to be basically sideways with a little volatility from day to day. However, I think we're going to see a boost in the economy second half of 2011, which will boost oil back probably close to that 115 level that we saw earlier this year. The other driver is going to be the U.S. dollar. You look at that U.S. dollar index. I looked at it just before I came here. It peaked out in 2001, around 125 in the index. We're now down to 72. That's an enormous hit. It's been in a downtrend now for 10 straight years. This government, regardless of what they have to say, there's no such thing as a strong dollar policy. The U.S. dollar, in my mind, will continue to fall, and that's going to push commodities higher.
But that dollar index, if you look at that dollar index, since 2008, since the Lehman crisis, I think we got down to 70 on that dollar index. So yeah, we're not that much above it, but we are above it, and we're above it even though we've seen two phases of quantitative easing, the most recent one ending, of course. But I mean, the dollar, it looks to me like it may be putting in a long-term bottom, no?
We're going to disagree on this. We disagree quite often. We're going to disagree on this, and I'll tell you why. I think the only reason the dollar is still above that 70 level on the index is because every other currency stinks as well. You look at the euro, why would I go out and buy the euro right now? So the fact that the euro is weak, the U.S. dollar in my mind is weak, and I think eventually the euro wins out. Even though I may not agree with what's going on in Greece, they're going to fix things for the short term, and that's going to push up the euro, that's going to push down the U.S. dollar.
So what's the short term in your view?
The short term on the euro,
yeah,
where we go? I think we probably have another 5 to 7% on the upside from here and probably test the highs from earlier this year. But then we'll probably be in a trading range from that point.
What brings the problems back? Are you saying that the current efforts to preclude a bankruptcy in Greece or default in Greece, you say that eventually it's going to unravel and eventually the problems are still there, they're not going to go away, and it'll come back to the fore?
Yeah, it's somebody with a gash this big in their arm, but they're putting a little Band-Aid on it. It may stop the bleeding for a few minutes, but eventually you have to deal with that issue.
And it's a country that keeps borrowing that already can't pay its bills, so you're heaping on more and more debt, and it already has a problem in being able to pay it back.
I'd rather at this point, let it, take the tough medicine, let them default, let's figure it out from there and start over. Very similar to what I think should have happened in the United States, with a lot of these firms in the financial crisis.
Yeah.
Let them go by the wayside. That's part of the free markets. Let that happen, and somebody's going to come in. The vultures will swoop it up and just and get it all out. Because not only here in the U.S. but in Europe, we just keep prolonging everything. And I may not be a bull in the economy. I'm bull in the stock market because I think there's some type of false rally built in that will continue. When you keep pumping money into the economy, it's going to go into stocks.
But listen, you're talking about keep pumping money into the economy. You've got quantitative easing, which has ended, and now you have real possibilities of austerity or huge spending cuts right here in the United States. I mean, don't you think that's going to have a negative impact on growth?
I don't know if it's going to happen, to be honest with you. I think they can talk about it all they want. It's going to get you elected, right? Because that's what people want to hear these days. But are they really going to do it? Are politicians really going to sit down and cut? I don't think it happens. I think it's a great talking point. It makes for great headlines. It gives us something to talk about. But really, I don't believe really when it comes to next year, we're in the same issue, Mike. I don't think we actually end up cutting anything.
Well, I personally,
and I know you don't want them to.
I hope you're right.
Yeah.
I know, because I think it would be a disaster for the economy. So from that, I kind of guess your outlook on gold, because you don't think there's going to be a serious economic contraction. You don't see a big pullback in spending necessarily. So I would guess that you're still bullish on gold, right?
I am still bullish on gold for that reason. Also, the reason that I don't like the U.S. dollar, I don't like the euro really longer term. So where do people put their money? They're going to go into gold. And I still believe that looking back when like a year ago talking about gold, it's a supply demand issue. I think that's in a favor of gold. I also believe it's a currency alternative, which I just talked about. And I also believe, which nobody talks about, it's a real asset class these days. And everybody always argues with me. People want to own gold. When I bring on new clients, one of the things they get asked all the time, how much are we going to put in gold? How much are we put in gold? And it's not just in a short term, it's something they actually want to have a portion of their portfolio in. It's not just to protect against inflation, which I think will be an issue down the road. It's the fact that they feel safe with a little bit of gold in their portfolio. And with the ease of these ETFs with gold, silver, every other metal, it makes it easy for that average investor to invest in precious metals.
Right, well, that's true. I mean, it's a lot easier to get involved nowadays than it was 30 years ago, although the people who got involved 30 years ago, they still didn't make their money back yet on an inflation-adjusted basis. So I don't know about that hedge against inflation part of it. But anyway, I know you're very much into the agricultural commodities, and I agree with you on that, particularly when it comes to corn, where because of a policy initiative here, the whole ethanol thing, we're basically burning up 40% of our corn supply to make ethanol. However, we saw now recently cuts in subsidies for ethanol. Do you think that's going to have a negative impact on corn prices?
I think it will, and just recently they came out with a pretty good weather report as well, and you see that move from day to day. Corn had a big run a few weeks ago, but it's gotten crushed the last 2 weeks. It's really come down hard, and that's hurt the entire sector. And when you look at the ethanol, that's a longer-term story for me. I think the government's going to continue to push the ethanol, even though I do not believe in it. I think they should completely get rid of that. In my mind, I think we should be pushing natural gas as a clean-burning fuel. We have so much of it here in the United States.
And it's very, very cheap.
It is cheap. And why take away food? And that's what it comes down to. People, there's more mouths to feed every day in this world that are demanding more food, demanding more corn. At the same time, we're having less supply of that corn because we're putting it into gas tanks. So that long term tells me grains will move higher. So I use these opportunities when they get hit 15, 20% in a matter of a month, which happens with a lot of these grains. That's my buying opportunity. When everybody's running for the exit and saying, you know what, we have enough corn for the next 5 years, that's when I'm jumping in and trying to buy into the ags.
Now, historically, if you look at commodities, it's been a cyclical sort of phenomenon. I mean, you go for a period of time, it could be 20 years where there could be relatively no price movement. Then you get a big spike, which is based on some paradigm shift or something. Then things tend to settle back down. But a lot of people are saying now that it's different this time in the sense that we're not going to get markets settling back down to a sort of a mean reversion, but we're establishing a new high plateau, both in nominal terms and in real terms, inflation-adjusted terms. Do you buy that?
I hate when people say it's different this time, because anytime they say that, they're usually wrong, because, everything has a pattern in my mind. I look at the charts. I don't want to say it's different this time, but I think there's more room to run, if that makes sense, Mike. I think we have some more upside. But no, we're going to have, I'm not going to call it a crash, but we're going to have a major pullback in commodities in the next couple of years because they're going to get ahead of themselves. And we've seen that in a lot of individual commodities. Look what happened with cotton, for example. I mean, that was all over the place, running up to 100-year highs and then got crushed. It lost half its value in a matter of a couple weeks, 2 months.
They tend to fall a lot
faster. And they fall fast.
So
the people that are chasing at the top, I don't think we're there yet, but I think before we get there, we're going to see this mad rush. Commodities are going to hit the headlines once again, and the individual investors, not you and I, are going to be rushing to get into commodities, and that's going to be the end of the run. And that's when it falls apart, unfortunately. Those are the people that are watching this are the ones that end up losing the money. I hate to say that, but they jump in at the end. The story's still going, but it is a bit long in the tooth at this point.
How do you gauge that, though? Is there a way, do you have a certain tool or technique or something that you look at to gauge when you think, the crowd is really in there?
This may sound very elementary, but when all my clients are calling and they're on one side, I do the exact opposite of my clients, and that comes a contrarian view. And I got to tell you, it works 90% of the time. A week or so ago, everybody's calling, we have to get out of the stocks. We have to get out of these stocks. So just give me 2 weeks. And now look at the markets bouncing back. So I hate to say to my clients that are maybe watching this as well are probably not too happy with me, but the average investor chases everything. So when I see everybody on one side, I'm going to start getting out of it. That being said, I kind of felt that a few times in this commodity rally the last couple of years, and it just keeps going. So maybe that's not the best indicator for commodities, but I think that's the only thing out there right now that I can use. It's almost like a feel. You've been doing this for a long time, too. You just have this feeling when everything's getting a little bit frothy, and you have to realize you're never going to get to the top. So, you sell half your position, take some profits, and if you lose a little bit, then get out of the rest of the half.
Well, my indicator is going to be when I see a corn cob on the front page of Time magazine. That's when I know it's time to sell corn. Anyway, I want to thank my guest, Matt McCall. This is Mike Norman. That's it for now, folks. We'll see you here next time. Bye-bye.